Hello everyone and welcome to this month's webinar. Today I'm going back to one of my favourite topics, Fringe Benefits Tax or FBT. What I'm going to talk about today is how to calculate Fringe Benefits Tax on motor vehicles. Now obviously Fringe Benefit Tax covers lots of other areas like entertainment and car parking and all those things, but today I'm going to talk about cars and how you calculate the Fringe Benefits Tax on that. And it's designed for people who have their own business and they have their own vehicles and probably their family and spouses cars also in the business, and how to calculate that. So that's what we're going to talk about. Just first though, a disclaimer to make sure you get your own independent advice before you do anything too crazy. And that's me. I'm Derek Nolan. I'm the owner of 12 Chartered Accountants. Been doing these videos for a long time, so you've probably seen some other ones I've already done. So this webinar is for the business owners. I know there's a lot of FBT webinars out there regarding salary sacrifice and how to calculate the FBT on when someone who's an employee and salary sacrificing a car and things like that. But this one's all about the business owner who owns their own business, usually through a company, and has their own private cars or their own family cars in the business. And it might be their spouses, it might be their children's cars, all those sorts of things. So we will sort of talk about business owners who do have employees who do salary sacrifice cars, but what we're talking about today is the business owner who has their own cars in their own business. So really quickly, what is Fringe Benefits Tax? Well, it's all about employees usually who get a non-cash benefit for working somewhere. Now, in most cases, FBT is for large corporations that offer salary sacrifice arrangements to their employees, and there's an element of Fringe Benefits Tax, which is either paid by the employer or the employee has to salary sacrifice it. But what we're talking about here is the business owner is considered an employee, even if they're just a director of the company. Now, also their family members and their associates are also considered employees, even though they may not be employees. But anyhow, so it's basically their own cars and dealing with Fringe Benefits Tax. It's applicable to themselves. That's what we're going to be talking about today. Now, I did a video a few months ago, and this was a big warning from the tax office. I was on a video with them saying that their focus this year for small businesses is cars that are owned by companies. So go and watch that video. It talks about how the tax office has gone to the RTA or the motor registries and got information for the last 5 years on all companies in Australia that own motor vehicles. And they've been going through systematically looking at to make sure there's FBT being properly recorded on those vehicles. So make sure you go and watch that one if you haven't already done that. Now, before we start, there's always some exceptions or exemptions to FBT for motor vehicles. And there's a few eligible cars, not nearly as many as there used to be. And we'll go through that why. The first types of cars are buses and trucks. Now, people most understand that trucks, large trucks we're talking about here, and buses that hold more than 7 people are just not motor vehicles. They're more equipment and they're not subject to the motor vehicle FBT rules. That's pretty obvious, that one. The second one is electric vehicles. So again, I did a video on this a few months ago with the introduction of FBT exemptions for all, well not all, for motor vehicles, electric motor vehicles now. There's some, there's a few tests you have to pass and the value of the car needs to be a certain amount and things like that. We'll go through that again a little bit later. And the third one is those vehicles that are designed to carry a load, like utes and small trucks and things like that. Now, the answer to that was a lot different prior to 2019 because the tax office changed the rules in 2019. Basically, if you had a car or a motor vehicle that was designed to carry a load, and I've done videos of this in the past where the cargo is more weight than what the humans in the car are. they were generally exempt from FBT. But now that's changed. From 2019 onwards, you have to look at the actual private use and see how much private use you're doing for those motor vehicles. So I'll go through those, but generally they're exempt. Again, just a really quick reminder about the video I did on the exempt electric motor vehicles. That's a pretty good one to go and watch. Now, the first thing you have to do is to start with a simple question. Does my company own the car or a car? Because this is what the tax office are asking. They've gone to the RTA and asked the same question. Give me a list of all cars that are owned by companies. Now, if your car isn't owned by the company, there's nothing to worry about for FBT, because you've got to have that connection first. And the way it works is if you've got a car that's owned by the company, for income tax purposes, you get to claim all the deductions for that cost, that car. You get to claim all the GST credits and everything like that. But the flip side of that, and the sting in the tail, is the FBT, where it works out the private portion of that. But anyhow, you've got to start with that question. Does the company own a car? Now, the first thing is, if it's an electric vehicle and it's less than $84,916 and it was purchased or first purchased after the 1st of July 2022, no problem at all. It's completely exempt from FBT. And that's a no-brainer now. If you want to buy an electric vehicle and it's less than $84,916, just get in the name of the company, because there's no problems with claiming the deductions for it, because there's no FBT to worry about. Nice and easy one. Go and watch my video on that one. The second lot is cars that are designed to carry a load. Now, many years ago, the tax office would come out with a list every year of exempt motor vehicles, and most of them will be utes and trucks and things like that. They stopped doing that probably about 15, 20 years ago. And then they just replaced it with this sort of formula where you had to work out the carrying capacity of the vehicle and how many humans it can fit. And you work out if it's got more carrying capacity than humans, it's designed to carry a load. Again, I've done videos on this in the past. And it used to be that was fine. If that was the case, it was exempt. But what they've done now, in 2019, they said, well, no, there's a lot of people now using these Hiluxes and pretty fancy utilities for their private purposes, going skiing and going to the beach and taking the kids shopping, all those different things. So they came up and said, really, they're only exempt now if you use those cars for less than 1,000 kilometers per year, then they're exempt, which isn't much. And there's all these rules that come up when but what they did allow you to do, which was great, was if you do have a vehicle that's designed to carry a load, your travel from home to your work was included as a work trip. If you've got one that's designed to carry a load. If you have like a normal sedan, that doesn't count. But if you do have a ute, at least the home to work and work to home was part of the percentage that goes into, or the kilometers that goes into a work trip, which is really good. So therefore, the 1,000 kilometers, you're really only looking at weekend travels and stuff like that. So now, if you can say, yes, I have a car that's designed to carry a load, and yes, I travel less than 1,000 kilometers per year, and you sign exemption and give it to your accountant at the end of the year, and you say yes to all those things, it's still exempt for FBT purposes, which is great. If you can't say yes to that, you have to say no. Unfortunately, you do have a car that's designed to carry load, but you do use it a lot for private. It then just becomes what the tax office calls an other motor vehicle, which is then subject to FBT under the normal FBT rules. So obviously the same thing, if you've got an electric vehicle that's over 84,916, that also becomes an other motor vehicle, and you have to go through the process of calculating the FBT. So once you get to this stage, there's two ways to calculate the FBT on a motor car. The first one's the statutory method, and the second one's the operating cost method. I like to call them the easy method and the hard method, for obvious reasons. And as you go through this video, you'll find out why I've christened them those. The statutory method is usually the cost of the car multiplied by a rate. Simple as that. Where the operating cost, there's a lot of moving parts. There's logbooks involved, there's receipts, there's invoices, and lots of other things to calculate interest and depreciation, things like that. But I'll go through all that through this video. So you've got logbook you need to worry about under the operating cost. You've got this deemed depreciation, deemed interest, and this interest, and you've got this thing called a grossed up value. I'll go through all those in a second. Because what this video is designed to do, to explain to people how complex FBT and the calculation is. It's not a 5-minute job by your accountant, by the way. A lot of people, when we start talking FBT, they go, "Oh, Derek, that's a 5-minute job. You've got all the information." Well, it's not as simple as it appears. So give your accountant a break when you start asking all these sort of loaded questions regarding FBT. The other thing that a lot of people don't understand is that FBT year is different to your normal income tax year. So your normal income tax year for GST and income tax goes from the 1st of July to the 30th of June. The FBT year goes from the 1st of April to the 31st of March. Don't know why, no one's really explained why. Maybe it was an April Fool's joke one year and they started 1st of April for FBT. But as you can see, they're completely different periods of time. So when you start looking at the simple things like the operating cost method, well, what you put in your tax return is going to be different to the cost you put in your FBT return because there's an overlap. So those simple things, once you understand, you realize it's not as simple as you first think. Now, like I mentioned, there's 2 methods on calculating the FBT on motor cars: the statutory method and the operating cost method. So I'm going to go through each of those in detail on how you do a calculation with a few examples. So the first one is the statutory method, or the easy method. I'll show you how easy it is. There it is, nice easy formula. Now, what those different components are, well, obviously A is the cost base of the car, what the value of the car was. B is the statutory rate, which is 20%. Now, prior to 2012, there was 4 different statutory rates. There was 11%, sorry, there was 7, 11, 22, and I think 30%. And those rates depend on how many kilometers in a FBT year that car traveled in total, not work kilometers, just in total. And so you probably remember those stories where people had to drive to Canberra and back a couple of times one weekend just to get the kilometers up to get to the lower statutory rate. Anyhow, those days are now over, and there's a blanket 20% statutory method used for all cars for all kilometers. Whether you do 1 kilometer or 50,000 kilometers in a year, it's still 20%. That's just the way it is. The C is the number of days that the car was available to you, which is important because most people go, "Oh, it's 365 days," but there could be some times when the car wasn't available because it was being repaired, or it was just left at your factory or your workplace and you didn't have access to it. D is the number of days in a year, which is normally 365, and C is the employee contribution. Now, later in the video, I'll really go through quite a detailed explanation of what the employee contribution is and how important it is. But yeah, that's our statutory formula to working out FBT. Now, the first component of that was cost-based value. You think, well, that's a pretty simple thing to work out, but it's not. For FBT purposes, the purchase price or the cost price of the car includes GST and doesn't include stamp duty, which is the opposite for income tax purposes. If you go and buy a car for income tax purposes and your company's registered for GST, well, you take the GST off. Let's go and say you pay $66,000 for a car. Well, you take that $6,000 off and you claim it back as a GST credit. And therefore, the real cost of your car is $60,000. And also, the stamp duty and a few things like that get added onto the cost price of the car, and that's the amount you go and depreciate. For FBT purposes, the GST is included and the stamp duty isn't. The other thing about the cost price, it stays the same. It doesn't get lower like diminishing value depreciation or anything like that until year 5. So the cost base stays the same for the first 4 years, and in the 5th year, it has a 1/3 reduction. So for example, the $66,000 car for the first 4 years, that's the cost base used, even though the car's definitely lost value. Like if you go and pay $66,000 for a car, in 4 years' time, it's not worth $66,000. But unfortunately, you're still paying FBT as if it was. And then in the 5th year, it drops to $44,000 and stays at that level until you don't have the car anymore. That's how the cost base is worked out. So it's a pretty tricky thing and not something that a lot of people are aware of. Okay, so here's an example. Let's say we've got that $66,000 motor vehicle, which included GST. We've got some operating costs for the year, $7,400. Let's say it's a private use of 25% and no employee contribution. Now, I just put those there because I'm going to use those numbers throughout the whole video today. Obviously, for the statutory method, we don't need those things like the operating costs and the percentage. They'll come later. So here's the formula. So I've got $66,000 multiplied by 20%, and then we've got 365 days that was available out of the 365 days in the year, and no employee contribution. So the taxable value is quite simple. It's $13,200. Now, I'll show you later what that means and what you do with that taxable value. Before I go any further, I just wanted to show you though about the days that it's available. That's really important because let's say, there's the same example, let's say that you keep your vehicle at your factory during the week for some reason, and you only take it home on the weekends. So therefore it's only available Saturdays and Sundays to you. So that's 2 days a week multiplied by 52 weeks, that's 104. Let's just say it's 104 days it's available, and a whole year. The taxable value is only $3,761 compared to the $13,200. So it's something to be really mindful of when your accountant starts asking you simple things like days that are available. Think about it. Now, a lot of people just drive their car home, no drama at all, and the tax office really look at where was it garaged that night. I do actually have a client who has an office in the city, and they own the converted townhouse in the city, and they live next door. So they make sure that the garage of the office is where she keeps her car. So therefore, it's not garaged at her home, it's actually garaged at her office, believe it or not. And believe it or not, it's actually then zero taxable value on her car because it wasn't garaged at home. Quite interesting, that one. Okay, I just got sidetracked on that one. So let's go back to our calculation. The next thing you do is you take this thing and it's called a gross up value. So that taxable value of $13,200. What the tax office says that employee, or you as the business owner who really is an employee, has got a value of having that car. You're not paying for any of the costs. The company is, and getting a tax deduction for it. So you've got a benefit, and the benefit is valued at $13,200. The tax office says, all right, how much should you have been paid gross before tax to be equivalent to have $13,200 net in your hand? To work that out though, they assume that you are on the highest marginal tax rate, including Medicare, of 47%. Now you probably aren't, but that's what the tax office do for the calculation. Plus, they go and add 10% GST on as well, because the company is getting a GST benefit. So therefore, if you're going to pay for it out of your own money, you have to pay that GST yourself. So there's this thing called a gross up value. And there's two types. There's type 1, which is for if you've got a company that is registered for GST. So all your car costs, you've actually claimed the GST back. The other one, which is type 2, is if you're not registered for GST. So the vast majority of people watching this and my clients are registered for GST. So they take the gross up method type 1, which is multiplied by 2.0802. So if you do the calculations, that's taking the GST and grossing up at 47% to work out a value that you would have earned after GST and after income tax to be left with the taxable value. So back to our example where the taxable value was $13,200, you gross it up by 2.082 and you come up with $27,459. The tax office calls that the reportable fringe benefit. So if you were an employee, and effectively you are an employee of your own business, that goes on your PAYG summary. And it goes there for things like, and anyone who sort of works for a not-for-profit organisation or works for an employee that does give you some FBT concessions and things like that, you'll see it on your PAYG summary, and that gets added for things like health fund rebates, the help debt, and other things like that. Don't pay tax on it, but just actually gets reported on your PAYG summary. But back to the company now. So the gross up value of that is $27,459. So what the tax office is saying is that employee hasn't paid tax on it, and if they were, the gross amount would be equivalent to $27,459. So the tax office then will tax the employer on that amount at 47%, which is the FBT rate. And it's been 47% for a long time. So the actual FBT liability on that example is $12,906. That's actually what you have to physically pay to the tax office in FBT for year one based on that example. So a $66,000 motor vehicle will cost you $12,906 in FBT. On the flip side, of course, you've been able to claim all those deductions relating to that car, the operating cost. You might have been able to write it off under the instant asset write-off and all those other things. So you got a tax benefit, but the tax office comes along and, yeah, you might have got a tax benefit there, but we're going to sting you here. Okay, that's what the FBT is all about. Letting you claim 100%, but coming along and stinging you later. Okay, so that was the easy method, believe it or not. One last thing though, is that no one pays FBT, by the way. So, which is hard to understand. What most business owners do with their accountant, they make an employee contribution. I'll go through an example of that in a sec, where the employee or the business owner effectively in this situation says, all right, well, that's great. I've got a benefit of having that car owned by the company, but I am going to make a contribution back to that company for my portion of it. So in that example would be $13,200. They make that contribution back to the company. And what that actually does, it reduces the FBT back to zero. And that's the way most accountants and their clients do it. For example, in that situation there, where you've got $66,000 at 20%, but you go and make an employee contribution, so you plug that into the formula there of $13,200, the taxable value then becomes zero. And of course, if you gross zero up, it's still zero, and you multiply zero by 47%, it's still zero. So therefore, that's the way you eliminate actually having an FBT liability. Now, that does have consequences, and we'll go through that later on how you account for that employee contribution. But I would imagine of all my clients here, I've probably got 200 or 300 business clients here, of which probably a third of them would have motor vehicles in their company, maybe more, but yeah, that's probably how many FBT returns we have to do every year. Of those, maybe one or two actually pay the FBT on their own personal cars. And there's probably reasons for that, because they just the way they do it. But the vast majority do an employee contribution and pay zero FBT. Okay. All right, method number 2 is the operating cost method. So you thought the first one was complicated? It wasn't. That was the easy one. This is the complicated one. So there's the formula. So on face value, it looks a bit easier. A times B minus C. Now, A is the total operating costs, but it also includes things like depreciation and interest. We'll go through those on how to calculate those in a minute. Multiplied by the percentage of the private use. Most people are familiar in a logbook and they know they keep it for 12 weeks, work out their percentage of private use for that 12 weeks, and then that can be used for up to 5 years. Most people know those sorts of things. They know it, but they never do it. And the C is the employee contribution, which we'll get back to later. So that's the simple formula for the operating cost method. Now, the tricky thing though is working out what your operating costs are. Now let's just say from this example we had some just normal operating costs, which includes petrol, registration, maintenance, insurance, those sorts of things. Now those things have already gone through the company, the GST has been claimed on them, and the net amount is sitting in your profit and loss statement under motor vehicle expenses. You've already claimed a tax deduction for them and the GST come back. So we're looking at those costs there, and they're pretty simple. Just run a general ledger and there they are. In addition to that, you have to add the depreciation on the motor vehicle. And the tax office for FBT called it a deemed depreciation because it's very unlikely that the depreciation for FBT purposes will be the same as FBT for income tax purposes. I'll go through an example later. Actually, there's no way it'll be the same. I can guarantee it'll be different. Plus, you have to add a deemed interest amount. Even if your car is not under finance, you must add an interest cost. And the reason is because the tax office says, well, if that was an employee and all of a sudden they've got this car, how did they pay for it? They didn't pay for it at all, so therefore they've got a benefit. They're basically, it's almost like they got a benefit from the company who paid for it, so therefore they should be paying interest on that. That's how the tax office look at it. We'll go through an example of how it all works. So deemed depreciation. In most cases, this will be different to what the company's tax depreciation is. Most people that run their own business understand how the depreciation on equipment works. Motor vehicles, equipment, office equipment, all those different things. They understand how that works. It did change a lot though during COVID and even before then when the instant asset write-offs came in and then the full expensing, which is, I've done videos on that as well. But I can almost guarantee that your depreciation for FBT is going to be different. And the main reasons are because your FBT calculation for depreciation must include GST. So in my example earlier, your $60,000 car will be on your tax return being written off over whatever, 4 or 5 years on the $60,000. But for FBT, you're writing it off at $66,000. So again, you've got a different amount to start with. The second thing is that the rate you use for FBT is a 25% diminishing value rate. Now, under income tax rules, you might choose a different rate. You might choose 18% prime or 20% prime or 22.5% diminishing or whatever you feel the useful life of your car might be. Or even under the instant asset write-off rules, you might have been writing off at 100%. FBT rules don't care about what you've done for income tax purposes. They just go back and say, all right, 25% diminishing is the only way you can write this motor vehicle off. Like I said, the car may have already been written off for income tax purposes. So you've taken your full deduction of $60,000 for that car. It's gone from your balance sheet, it's gone from your depreciation schedule, but this car hangs around for FBT purposes until you get rid of it. Written off over the next 3 or 4 or 5 years, 4 years. So it's really important that you understand there's a difference between FBT depreciation and income tax depreciation. And again, the other thing is it's a different year. So even you've done these depreciation schedules from the 1st of July to the 30th of June, you need to do another one for FBT from the 1st of April to the 31st of March. So yeah, I said there most cases, 100% of cases, your depreciation rate will be different to what your income tax rate will be. So you need to keep separate work papers. So again, it's frustrating from an accounting point of view or an accountant's point of view. We need to double up with all our work papers for FBT purposes. That's just the way it is. Okay, so a quick calculation here. Let's just say there's that $66,000 car, including GST, multiplied by 25%. And again, the days here is just when it started. So in the first year, you might have bought the car on the 1st of January. So therefore, there might only be 90 days before the end of March divided. So therefore, you just do a calculation on a pro rata basis for your depreciation. So $66,000 at 25% is $16,500. Now what happens though, because of the diminishing value, the second year, it's less. So the 25% is only on $49,500. So therefore your depreciation in the second year is $12,375. And your third year might be $9,000 roughly. Fourth year might be $6,000. So at 25% diminishing, you'll never actually write it off. It's not like prime costs or anything like that. So you'll always have this sort of depreciation value for your car, and probably until you get rid of it, which is different for tax because you've probably written it off. Okay, so that's how the calculation works, 25% diminishing value. Now, the same thing is deemed interest. Like I said, even if your car is not under finance. So it's very common for a lot of companies to take a hire purchase or a chattel mortgage on the car. But even if you haven't, even if you just had $66,000 in the company bank account and you chose to just pay cash for it, FBT rules say, no, you still need to calculate a deemed interest on that car. And it needs to be at the inclusive GST amount. The interest rate for 2024 is 7.77%. So even if you do have under finance, and you might have got a really good rate a few years ago, 4 or 5%, doesn't matter. For 24 year, you have to calculate at 7.77%. So every year, the interest rate changes, by the way, where in real terms, you might have financed a car a couple of years ago and it's locked in for 60 months or something like that at the same rate, interest rate. No. FBT rules require you to change the interest rate on the calculation every year. I'll go through the different rates in a sec. So again, it's irrespective whether the car is under finance. And again, it's for a different year. It's not the tax year, it's for the FBT year. They're the interest rates that the tax office tell you you must use. So as you can see in 24, it's jumped to 7.77%. Prior to that, it was only 4.52 and had been for a couple of years. Now, the bizarre thing actually, from 21 to 22, it actually dropped. And from 20 to 21, it dropped. I don't know how that happened because I'm pretty sure interest rates were going up those years. But anyhow, FBT has a mind all to itself. But they're the FBT rates that you need to be using over the last number of years. Okay, so here's a quick calculation on a $66,000 car, including GST, at 7.77%. The deemed interest is $5,128. And the same thing is like depreciation. In the second year, it's on the written down value of the car. So you take the depreciation amount and apply the interest rate, whatever next year's interest rate will be, might be 8%, might be 9%, who knows? and multiply that out. So in my calculation there, I've just done it at 7.77 again. So the interest in year 2 would be 3,846. So they're the different calculations you need to do from year to year. So again, just recapping that, to come up with your operating cost calculation, there's your actual costs. Nice and easy, net of GST, straight off your profit and loss account. But again, you've got to look at the different year. You can't just go and take your 2023 financials. You need to go and run it from, and that's the great thing about a lot of the software now. You can actually run it from the 1st of April to the 31st of December and get that whole number, where before you had to run it for 3 months and then 9 months and add it together and things like that. So they're your operating costs and all the things associated with those cars, plus the deemed depreciation, plus the deemed interest. So just going back to our original example, where we had those things, which is the $7,400 worth of operating costs, plus our deemed depreciation, plus our deemed interest, our total operating costs for that example wasn't $7,400, it was actually $29,028. That's our operating cost, and that's how we come to it. Now, obviously, year 2 will be slightly less than that because the depreciation will be less and probably the interest will be less depending what the rate is in the second year. The second part of that formula is your percent. Now, most people understand this. To work out your private bit, you keep a logbook for 12 weeks and work out the private divided by the total number of kilometres and come with a percentage. Most people get that. So let's apply those numbers then. You've got your 29,028 at 25% private use. So we sort of put that in earlier, just assume that's a nice number to work with. In this situation, there's no employee contribution. We'll get to that in a sec. So therefore, under the operating cost method, the second method, your taxable value is $7,257. Then we apply the gross up to it, which is the 2.0802. So therefore, your reportable fringe benefit amount is $15,096. Multiply that by 47%, and you have an FBT liability of $7,095. So therefore, comparing the two with pretty much the same example, you got your statutory method, your FBT payable will be $12,906, but your operating cost method with all the deemed depreciation and the deemed interest is $7,095. So comparing the two there. So in this situation, the operating cost method will be the one to go with. And that's what I say is that you don't have to choose which one to use. You do the calculation on both and pick the best one. What I find though is most people fail to keep the records for the operating cost method adequately. The main thing is the logbook. I asked for a logbook, I never get one. I had an audit the other day. Like I said in my video, the tax office is starting to crack down this. Sure enough, they asked for a logbook. So that my client is now struggling to try and find their logbook. They promised me it was somewhere. So yeah, there's comparing the two, and you take the best one. Now, what I want to do just quickly is, with that, let's just compare it to make them the same. And as you can see there, let's make the private use 45%. Because at 45 in this example, the FBT payable for both methods works out about the same. And you'll find more expensive cars may be a little bit lower private percentage, but it works out about the same most times you do it. So if someone says, all right, well, what method will I use? If you're using your car for 55% or above for business, which obviously means 45% private or less, you'll most times go with the operating cost method. And probably for your car, that's fine. But it's the children's car and your spouse's car you're probably looking at a much lower business use. You'll probably end up going with the statutory method, which is usually quite a significant FBT bill. So that's sort of just working on the sort of the break even. One thing I wanted to touch on, I did say one of the tips was that most business owners, with their advice from their account, is they make an employee contribution. So let's go back to that example using the operating cost method at 25%. So the taxable value, remember, was $7,257. So let's make an employee contribution of $7,257. So you plug that into the formula, the taxable value is now zero, like we talked about before. So the gross up of zero is zero, and 47% of zero is zero. So there's no FBT liability if you make an employee contribution. So therefore, when you get to this point, you have a choice. And like I said, most people end up going with the employee contribution as opposed to actually paying FBT. But there are your two choices. Under this operating method example, you can either pay $7,095 to the tax office, or you can pay $7,257 to your company. Now, obviously, the $7,095 gets paid by the company, and the $7,257 gets paid by you, or gets debited to your loan account, which you're probably familiar with. It's not quite as simple as your first thing, because you've got to remember an FBT payment is actually tax deductible. I know it's weird to think, but if you make a tax payment to the tax office, it's actually tax deductible. There you go. So therefore, you're actually getting a tax benefit. So if you go and pay $7,095 to the tax office, it'll actually reduce your income tax. And let's assume your income tax rate for your company is 25%. You actually just saved $1,773. So your real net cost is only $5,321. So you've got to remember that there's actually some tax savings by actually paying FBT tax. The other option is the employee contribution. So let's say you've got to physically pay $7,257 by your own money back to the company, or you do a debit to your loan account. Yeah, with loan accounts, with most people, you've had to put money into your company to start with. So it's actually money that's owed to you that you can take out whenever you want. Sometimes you say, oh, listen, I'll just use that money myself for some private expenses, or I'll apply that to my employee contribution. That's sort of how it works. The tax office do hate when your loan actually flips around where actually you owe money to the company. They don't like those things. But anyway, that's for another day. With the employee contribution, though, it's actually taxable and it's subject to GST. So if you go and put $7,257 into your company, you've got to pay tax on that at 25% and GST at 10%. So it'll actually cost you $1,814 extra in tax and another $726 in GST. Now, most people the income tax sort of gets buried away a bit. They don't really notice it. But the GST sort of stands out because at the end of the year, you get an email from me or an email from your accountant saying, oh, by the way, Bill, you need to pay another $726 in GST. And you go, why? Oh, that's for the employee contribution. What? What's an employee contribution? Oh, just pay it. So most people sort of forget about it, but you've got to pay it. Because you've got to remember, you got 100% deduction or 100% GST back on all those running costs in the first place. So now you've got to put your private portion back into the company and pay the GST back. The other thing too, though, if you put that money into the company or sacrifice some of your loan account, you still got to get that money out one day. So therefore, you got to get it out as a dividend. And by doing that, you got to pay tax on it. Now, by paying the 25% company tax, you get a franking credit when you take it out. You still got to pay the difference. So I'm assuming here in this example, you're on the 39% tax bracket. You might be on the 47, you might be on the 34, doesn't matter in this situation. So it's still going to cost you money to get that money out of the company. So in this situation, it costs you another $1,016. So your net cost at the end of the day will be $3,556. Now, it's still better than paying the FBT, but it's not a lot better. But like I said, the vast majority of my clients end up doing employee contribution as opposed to paying the FBT. And that's why, because the numbers tell you to do that, okay? The important thing here is you have to do one or the other. You can't just ignore it. You can't just say, oh, Derek, 100% of my car and my spouse's car and my kid's car are all business. Don't worry about it. If you do that, and the tax office are now going back to the RTA and getting a list of all those cars, they are coming back now and looking for two things. I go through this in my other video. They're looking for an FBT return being lodged, and they're looking for the company tax return. Item 6I in the company tax return is employee contribution. If there's no FBT return being lodged and tax being paid, and there's no contribution being put into the company tax return, they will be all over you, looking for an explanation on how you come up with 100%, because they won't believe you. Okay. So just to recap, FBT is complicated, and you have to understand how complicated it is. It's a completely different financial year, so that's why your accountant will start asking for information in April and May, which is different to your financial year end for tax returns. Another thing I didn't mention before is that you might be depreciating your car, but you have a luxury car. You might have spent 120 grand on it. For tax purpose, you only get to write off, for depreciation purpose, up to about $70,000 on that car. It's a bit over, you don't get to write off. But for FBT, you calculate the deemed depreciation and the deemed interest on the full amount. So that can really hurt. So don't even go there with luxury type cars. Like, it really hurts. I didn't even do an example of that because it was just too ugly to even think about. However, electric cars are a no-brainer. If you want an electric car under $84,914, buy it in your company, no-brainer. Third thing, keep a logbook. At least give your accountant the option of doing both methods. Don't just say, oh, it's 75% Derek, because the tax office will be asking for logbooks this year. I've already been asked for one this week. I hadn't been asked for like 5 years. They are coming after your logbook. So just please do them. And like I said before, it's not as simple as you think. You just can't go and take the same numbers out of your income tax return and plonk it into your FBT. To be honest, a lot of accountants don't even realize this. They just go and take those numbers, easy way, throw it into an FBT return without thinking about it too much. But you have to think about it. And like I said, the tax office has already come out and said they're focused this year on small businesses that own cars. Okay. Now, I'll wrap it up there. Now, I did want to go into the ultimate question. The ultimate question is, they say, well, that's great, Derek. I've already got a car that's owned by the company. You've explained how the FBT works. Which method to use? Before I buy my next car, should I buy it in the company's name or my personal name? And that's a really good question. I get it over and over again, but unfortunately we've run out of time today. I will answer that question in another video. I promise on that one, because it is quite complicated. Now factoring in all the FBT components and all the moving parts, it's a different answer to that than it was a few years ago before 2019. You've got to consider a lot more now with the deemed interest and the deemed depreciation and the luxury car levels and all that sort of stuff. But I'll do a video on that very, very soon. Okay. All right, I'm going to leave it there. Hopefully you got a fair bit out of it, and I look forward to talking to anyone about any questions they've got. Check out my website, got lots of other good videos there. And give me a call if you've got any questions. But all right, thanks very much for watching, and goodbye for now.